Welcome back to the Gray Report. We have an update on the wall of loan maturities that has been facing down commercial real estate, multifamily, but all asset classes in commercial real estate. The Federal Reserve Bank of New York put out an entire research paper just last week on extend and pretend in the U.S. commercial real estate market. Those wall of maturities, they haven't gone away. They've just been extended and pretended multiple times. We're going to give you the complete update to help you make some really informed decisions on the state of the commercial real estate market. But also today on the Gray Report, we're going to be looking at the U.S. consumer confidence from the Conference Board. Also from the Harvard Joint Center for Housing Studies, we're going to be looking at the role of recent immigration surge in housing costs and comparing that to some other studies that may show some divergent opinions in data, which is it's a very opaque situation. And then from Institutional Property Advisors, near record product absorption maintained through the third quarter. That's some good news, but on some maybe less good news from Apartment List, we've got a national rent report for October 2024. So if you're a real estate investor, multifamily, whether active or passive, you have just been in the trenches working in the industry, welcome. Thank you for your time. We cover all the latest research reports, data, and throw out some original opinions on the multifamily industry, housing, commercial real estate, and the macro economy. Joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. You're going to stick around. We've got a great episode. Let's get into it. Welcome back to the report, Matt. Hello. How are we doing this week?
Pretty good. Pretty exciting. You know, a lot of cool stuff that we could cover this week. So
we got Halloween.
Yeah. Oh yeah.
We've got a presidential election, like right on our heels.
Yeah.
But I don't even know if we're going to talk about either of those things.
Nope.
I don't know. Maybe we'll talk about the presidential election. But we've got more. We got bigger fish to fry.
Oh yeah.
But it's been an interesting week. I mean, really last month and a half, Matt. I mean, we went from treasuries, interest rates falling. Now they're rising again. We had some early job numbers from ADP that came out today that's saying that the jobs report that's going to be released this Friday may be stronger than what it could be anticipated.
Oh, interesting.
And so this idea that, maybe we don't see rates coming down as quickly as we'd like, or maybe not a whole lot at all. And then it's different from talking about treasuries and Fed funds rate. And all of this is dovetailing with multifamily markets, commercial real estate markets, because, buyers were coming off the sidelines when rates were falling, and now everyone's kind of doing a double take of, is this, do the deals pencil? Because sellers had an idea that they wanted to get some pretty decent prices, but math has
and it's funny. It's funny too because we'll cover some of the recent data we have on consumer confidence and or consumer sentiment or however they're measuring it, whatever they're calling it. It's improving, and you'd like to think that maybe institutional investors are like a step above the common folk when it comes to how the vibes are on the economy, but they're part of the people just as much as anyone else. How much of an effect does the Federal Reserve and the federal funds rate have on determining sentiment? And did the 0.5% reduction that we had in September have any effect on people's feelings? Were people tuning into the broadcast when he announced it, or have they actually felt it in maybe lower credit card rates or lower loan rates or something? Or has it just been a wash? Like, it's really too small to have an effect? Like,
my bet is on it's kind of too small and it's a wash. And, again, 50 basis points wasn't going to probably make or break anybody's deal or living situation.
And regardless of whether regardless of all the political BS, if I must say, consumer confidence is improving, and the improving jobs numbers kind of lends support to that. There is a case, and unfortunately, it's not going to be great for people that are looking for lower interest rates, maybe, but overall activity in the economy could be heating up slightly.
Well, that's what I'm saying with this new jobs report. I mean, I think that, again, it was the ADP report, which is different from the BLS report that comes out Friday. I think estimates on new jobs are like 110,000. They just posted like a $230,000 230,000 new jobs on the ADP report. Again, we'll see what the BLS report says on Friday.
Yeah,
but that's certainly more inflationary than deflationary. So again, will we come back to this the trend of kind of moderating growth, slowing growth, or are we reaccelerating?
Yeah.
And if Trump does get elected, which again it's kind of a coin toss, but I think slightly leaning towards Trump right now. I mean, the big negative or anti-growth measure are the tariffs. But I mean, if you look at generally, lower regulation and probably the tax code, when it has to be redone in a little over a year from now. Those are the two major impacts on the economy that at least people will feel. Again, maybe it's perception rather than reality. I don't think that any policy from the president has that much effect, but it can change the kind of the mindsets and the direction.
Yeah.
And if people think there's going to be more regulations and higher taxes, maybe not as excited as we saw. I mean, when the Tax Cut Act that was passed under Trump, I mean, you can look at markets. I mean, it was pretty much a hockey stick after that moment of economic growth. So
we can just jump right into the conference board if you want to.
Yeah, I think that's appropriate. Right. Let's jump into this piece from the conference board. Well, how's everybody feeling?
We did cover consumer sentiment a couple weeks ago with Jay. We talked about some information that came out from the New York Fed. But this conference board is a little bit newer, and this was the oldest data at the time, so I wanted to give a little bit of an update. Conference board had consumer confidence going up, really surging up. I think they used a lot. What is it? Bounced back, rebounded. That was the strong language they used in their headline. Is this a vibe shift for the economy? I would kind of add to this. So in addition to consumer confidence jumping up from around like 100 to maybe looks like 107 or 110. I don't know. I don't have the specific number, but it bounced like maybe like 10%ish. The important point is that it has gone up at a pretty good clip. And it is a sign that correlates or at least agrees with a lot of the information from other places, such as University of Michigan. They have consumer sentiment going up. The OECD, which is a kind of an international group, has U.S. consumer confidence ticking up slightly in their consumer barometer. I'll also add that a recently published report argues that same University of Michigan consumer sentiment survey, which is pretty big deal when it comes
to gold standard.
Yeah, exactly. Yeah. That actually should be a little bit higher than it is right now because they switched from phone surveys to internet surveys. And when they switched to internet surveys, the consumer sentiment tanked by like 9 points.
Oh, interesting.
So there's that structural issue that was related to the way that data was gathered. And it's a little bit nerdy and in the weeds, but the upshot is like we're a little bit more confident. No matter if you're taking that into account or not, like there's been recent increases in consumer confidence. Now, I want to do one more thing because we have a little bit more people are tracking inflation expectations. Now, that's something that we were just talking about.
Not a shock.
I think that is a particularly political partisan issue too.
Oh, yeah.
If you are Republican, you want to think, you're motivated to think that inflation is stronger than it is. There may be some nuance to that, obviously, but I would bet that is more of the case.
I don't think there's any nuance anymore. I think it's all been all been lost. It's just things are more expensive.
And I think that is kind of actually the
they don't even have to be more expensive.
Yeah, I know. Exactly. Yeah, you can just feel it. And that's what we're talking about right now. What do they feel? The expectations and kind of this feeling of inflation. It actually ticked up this past month from the conference board from 5.2 to 5.3. Now, that is an average and not a median. I say that because U of Michigan has their median at 2.7%, which is not 5.2%, and their average is I dug into the data a couple of weeks ago. Their average for U Michigan is like 4.7 or something like that. So clearly there is a variance, and I would argue that the variance, at least at first glance, it seems like we are a lot farther apart between the high outliers and the median. It's because there are people that are like, yeah, it's going crazy right now.
Yeah.
We're in election season. That's my own opinion. But again, to look at the median here, so we've got 2.7. People from Michigan. You get from Cleveland Fed, it's 2.26. From the New York Fed, it's 3. From history, it's 2.4. That's the CPI. And then PCE measures it a little bit differently, so I can't really take that into effect. Yeah. But like all of these measures, including the PCE, show expectations going down. This is for annual inflation. So all of this, regardless of whether you're thinking it's high or thinking it's not, the expectations for inflation are decreasing.
Yeah.
And so that's like the bottom line upshot. I think this most practical takeaway. And then also this consumer sentiment generally is improving. So it's good news.
And on top of that, because I'd agree 100%, but we got also the chance of a recession. The perception of the likelihood has gone down considerably. I mean, where it was, kind of peaking in like April and May of 2023. I mean, we're at this only goes back to July of 2022, we're at the lowest point of where we think that there might be a recession in the last 2 years, which, I'd love to see if this chart went back further and if there was like an absolute inversion and correlation of when we were least likely to think there'd be a recession. Is that the most likely time?
Oh, yeah.
But as I just wrote, Matt, when I was doing a write-up for our quarterly reports for the Gray Fund, I made a couple comments that, I don't really see... I see no fundamental reasons why there would be a recession in the near to medium term. Now, technically speaking, like as we've talked about before, when the yield curve reverts, there are technical signs of where we could be heading towards a recession, but there's really nothing kind of fundamentally. And I'm not so much of a technician where I'm going to say, there were a recession just because these two data points are pointing in a direction when the data is so messed up over the last couple of years. But it is interesting, again, just coming back to sentiment, not what's going to happen or not, but the consumer, in general, the population, has to be more optimistic if they don't think a recession is around the corner. I mean, this better or worse metric here will show right here also. I mean, the better is going up. Family expected financial situation 6 months hence. Yeah. People are more optimistic now. Is that politically because they think there's going to an election, or I don't necessarily think so, because I think people are just. Maybe it is because we didn't have the recession and we're just dealing with the day to day, and we're like, you know what, we're all still here, we're all moving forward. As much as things are different, and we go and complain about the cheeseburger being like $25. The fact is, everybody's wages, I say everybody, the vast majority of individuals' wages have increased over the last couple of years. Not that a ton of people are like absolutely excelling, but people are absolutely surviving and are a little bit optimistic for the future, which is always a good thing. Yeah,
and just to kind of bring it back to our world of multifamily investment, I know this isn't a direct study of like apartment investment prospects, but I think it's relevant.
It is, like 100%.
To me, like I said, like maybe the institutional investor is like far different from
what investor is going to be like, sign me up for whatever investment other than like bonds or gold if there's a recession around the corner, if the economy's in the dump.
Exactly. And I want to say, like, it almost feels kind of redundant to defend the relevance of this data, because it's like if you're pitching an apartment investment to an investor, well, like, there's going to be a mood that's going to be a factor in their decision. And like they may deny it, and it's all about, but like the way that you approach any data, you're going to have to bring your, I hate to say it, but like your gut to it. It's a small factor, maybe. But
and some people are just sort of like, they're done being on the sidelines. And their gut is saying maybe it's mixed with them with a little bit of FOMO.
If you are, and that's what I want to say too, is like, if you are, investment involves speculating on stuff that is not sure. You don't know, nobody knows the future, so you're going to have to bring something that's not necessarily completely fact. You have to do that extrapolating, and that extrapolation it leads a little bit to the bias, to the sentiment, to the mood, to the vibe, whatever you call it. But I think it's relevant to know where people are feeling, and there's some accuracy too. That's I throw away feelings too because they're stupid, they're dumb, right? They're not facts, but feelings,
they're tools. I don't think
they can point to where the facts are going. You may be able to see a bump in sentiment that precedes, or a decline in sentiment that precedes a recession or a boom time.
I made a really bad video about 3.5 years ago about emotions in investing. If anybody wants to see a very much OG Gray Capital YouTube video made in my basement,
it had some tactical usefulness for sure.
That's what I'm saying. If you use it as a barometer and as a meter, and you don't just put all the weight on it, it can emotions are powerful. We can perceive quite a bit. Now, they can sway your thinking and reasoning to ways that are outside of the reality, but if you keep it in check, it can be an incredible tool.
So totally agree.
So while things are looking great, let's talk about a little update on the doom and gloom of the market absolutely crashing. We published a couple research reports too, in fact, on loan maturities in the multifamily industry and the risk that they pose. Now, while some people were calling for absolute, Armageddon, I think ours was a little bit more nuanced and really just laying out the risks. And I think we were very spot on identifying what those risks were and some outcomes. And we said, one outcome is that most of these loans will be extended to where basically the the lender is saying, yeah, we know that the value is way low. We know you're having problems, and typically that note's coming due in 6 months. But man, we don't want to deal with your problem property. We don't want to take the keys from you. And in fact, our analysis shows that maybe interest rates will come down, and you're a client of ours. Let's give you another 6 months. Let's give you another 18 months maybe to see if this whole situation just solves itself. And if we just kind of don't look at the price for a while, the next time we look, all the numbers will work. And that has essentially become policy for all lenders across not just real estate, all asset classes, the Federal Reserve. And so the Federal Reserve just this last week, in October, they put out a whole 50-page document basically going over giving us an update on how extend and pretend is going. And as it is imagined, that wall still exists. It just has been pushed back multiple times. Matt, I know you've gone through this report in detail. We're working on our own report to kind of supplement this report, summarize it for folks. That'll be available soon. Give us an update, though.
I think that your depiction really actually jibed so well with the way that I approached this report. At first, I pictured these bankers' decisions, and I'm glad that we followed this with talking about sentiment, because at first I thought, all right, what is motivating these bankers? Almost kind of like on an individual level. I thought of them as like the bankers in Mary Poppins, the people in top hats that are deciding, oh, I'm in a good mood today, let's give them a loan. But as I read this report, it was far more of it was almost like revealing a natural law. Like when banks were in trouble, especially weakly capitalized banks, they were motivated almost like a property of physics. They were motivated to give people loans more easily, to extend and pretend more easily.
The worse the problem is, the worse the shape the property is financially. The guidance.
Well, that was the guidance last year.
The guidance was basically to be more calm. If you've screwed this, the more you screwed up, the more we're going to help you out.
Yeah, and that was a guidance in June, I think, of last year. Things have, and that's the other kind of subtext, I think, to this. I think that the upshot to this whole thing is like, well, the New York Fed thinks that things are going well enough that banks aren't going to be vulnerable to, aren't going to be vulnerable if the CRE market stops extending and pretending.
And the strategy part of it is not just like we're going to ignore it and whatever. The strategy is, all right, we're going to realize some of these losses. Let's not all have it happen in the same month or the same quarter.
And that's what
we showed. There was a huge concentration at the end of 2022 going into 2023, like massive concentration. And throughout 2023, throughout 2024, but by, extending this out 9 months, 12 months, 18 months, 24 months, you can spread that pain over and give some more time for these deals to maybe work themselves out.
Yeah. And so in the end, like you could argue, and I think I would too, as like this is a note of confidence that they're able to say, all right, it's time for banks to get strict again. When last year they were saying, let's have banks be a little bit more forgiving, have a little grace, would you? But the upshot to this whole, like, on a practical purpose, if you skip to page 37, here's the highlight. There's a new wall of CRE loan maturities, and it's set to expire in 2026. This wall is probably less strong or less steep or whatever, however you say. It's not as dramatic as it was maybe when we were predicting it in October of 2023, but it's there nonetheless. And it could be more dramatic if banks are in a different disposition, whether you're talking about like financial disposition or personality disposition, whether they're willing to get strict. And it, again, like,
which they don't really want to. That was some lessons they learned kind of the great financial crisis.
Yeah.
That was like, look, we're not property managers. We're not really good asset managers. We don't really want to own these properties.
Yeah. And just to kind of explain what they're working with and the assumptions that they're working with in this paper. So what fueled this what fueled this wall, I think, is partly the extension of loans that were made, previously. Some of them may have been in the loan maturities that were in 2023.
Yeah.
But again, there's a new deadline, and that deadline peaks in 2026. I think that, so essentially they are, I'm going to quote here, the conceptual framework of the author centers on banks' incentives to extend the maturity of their existing impaired loans to avoid writing off their capital. This incentive is particularly pronounced from 2022 Q1 onward, as rapidly rising rates created large mark-to-market losses on securities held by banks, eroding their economic capital. I just think that's a nice summary of what they're dealing with in sum, right? And they've got 5 parts of their analysis. Really, I want to go over it just briefly, kind of as a summary of the paper as a whole.
Give us an update.
So the first, they say that credit risk in the CRE market has increased in the post-pandemic, but weakly capitalized banks in particular have been sluggish in assessing the associated losses. So there's a motivation, whether you can, it's not I keep saying motivation in human terms, but there is a financial pattern that they have seen. All right, as this happens, as crisis increases, there's been more reason for them to not assess the losses associated with it, right? There's some trigger.
They don't want to look at it.
Yeah, they don't want to look at it. Exactly. That's a good summary. Okay, number 2, undercapitalized banks disproportionately extend these maturities of these distressed loans, so they don't look at it, and then they extend it and understate their default probabilities. They did a good study. There is
came down the road.
Yeah. And this is the quote here, the same and they did a study of all these sample banks, and they said the same borrower is assigned a systematically lower probability of default by an undercapitalized bank compared to a well-capitalized bank. And so the
lower capitalized banks are just being a little looser.
Yeah, and it's not because it's they're pulling their hair out. It's like a spreadsheet. You look at the spreadsheet, it's like X, Y, we have to do this here. And I really don't think it's because
more institutional systems. You're just a number. We've got 1,000 loans to deal with. Hey, some of these we're going to write off, and maybe we have the resources like asset managers to actually deal with some of these properties.
Yeah, exactly. And number 3, a loan to a CRE REIT that's experienced a large valuation decline is assigned a lower probability of default if they're in a weakly capitalized bank. So that kind of follows from the previous one. And then number 4, the maturity extensions granted by weakly capitalized banks result. So now they're getting into the effects.
When they say weakly capitalized, they're talking about regional banks for the most part.
I think so, but on a technical,
not the JP Morgan. Obviously, Chase's.
Yeah, I think they are, but they are talking about people that have a lot on their books. And
so it could be a larger institution. But most likely not regulated like a large bank.
That's my assumption here. And when they're talking about effects, it has had a material effect on reduced credit origination for both CRE mortgage credit and for what did they call it? Commercial and industrial uses. That kind of credit to firms for ongoing credit payroll and stuff.
And that's just confirming what we've heard, anecdotally from lenders or developers, is that most banks, regional banks, which are lending on typically they'll certainly lend on multifamily, but we're talking a lot of industrial, office, other types of commercial real estate assets, but also development, whether that's multifamily or bridge loans, also related to multifamily. Those are the types of, because multifamily acquisition, so much of that has gone to the agencies, Fannie Mae and Freddie Mac.
Okay, yeah.
So, but we're really talking about these smaller, relatively smaller banks that have slightly different terms, but it can be more competitive in the private market rather than like a commoditized product like Fannie Freddie, which is very great terms, but they lend on certain things.
And we've talked a lot about zombie properties or even zombie companies. You've heard about.
I saw that they mentioned zombie lenders, zombie lending.
Oh yeah, that is in the keywords and right next to their abstract. But it's this idea that this guy that didn't have a great property or didn't have a great the investment's not doing well. So why are you giving them? Why are you letting them limp along? It's because you don't want to lose money either as the lender, and the effect of that has meant that people with better ideas that have a better vehicle for investment or for getting that loan, they're unable to get that loan. So it has actually crowded out, and that's what they say in this part that fourth piece of their analysis.
I think that those are some of the unintended consequences of part of how the whole financial system is built right now. We don't want to experience pain. We kind of have a little bit of a Teflon society anyway. Everyone needs to be kind of reaffirmed and happy in everything, which is great, but you can't have the ups without the downs, right? And for something to really functioning to maximize our potential, and it creates a moral hazard. If you can screw something up, if you take someone's money and lender's money and you don't do a good job, the way that capitalism is supposed to work is that the market lets you know by you losing money, and the market should let you know if you make money. You're doing the right thing. You're doing an okay job. Not that you can do a bad job and still make money, and you can do a good job and lose money. But generally, that's the way it should go. But in this paradigm, we're almost rewarding, in some cases, incentivizing bad behavior because,
or at least at the very least, it's like not letting the people with good behavior get.
Doesn't make a. So you've got massive big developers who haven't made good decisions, but they're still getting all the deals. They're taking up all the bandwidth, whether that's city and government incentives, whether that's just lending capacity, the whole gamut. They're not letting any new firms who are better, more efficient, and could outcompete these other firms, but they can't because they're getting essentially bailed out by the more you screw up. And sophisticated real estate investors know this, and so it's not that always that they're always a bad owner or manager. And so where I've heard people talk about this, of where it's like, the deal didn't go as well as we thought. Again, not that they're a bad manager, maybe they paid too much money, just a bad deal. The strategy is not to, what can we do to make it right? What can we do to fix it? What can we do to add value? It's, we have to run the thing into the ground so the lender gives us more time.
Oh, yeah. Wow. Okay.
And that's what happens. Why wouldn't you? To access better terms, just do, like they made a whole memo last year. They made a whole memo.
To describe that memo. And this is referring to
guidance, not just a memo. It was like, this is what we want you to do.
To a guidance that was published or released, whatever, in June of 2023. I think it's kind of fair to compare this process of extending and pretending to that guidance, and I'll quote from it too, because this was they were calling
pretend as a tool.
They were calling guidance. They were calling workouts or accommodations. And when they define those workouts and accommodations, here's a quote. All right. Loan workout arrangements can take many forms, including but not limited to renewing or extending the loan terms, granting additional credit to improve prospects for overall repayment, or restructuring. So they were calling for that then. I do think that what's different, right? What's motivating them then was a more vulnerable financial economic situation, and maybe it was also like, was that around when the banks were. When there was like a run on the banks kind of
originals.
So there was that was in the air kind of, and now in this year there is a more positive there's more positive interest rate trajectory. There is a more positive in that, like, interest rates probably are going to be coming down in the long term and medium term, and in the short term we have been seeing some CRE price increases. So we are digging ourselves out of the hole that we've been getting into. And essentially by 2026, I looked at all these different price trajectories for whether it's industrial, retail, hospitality, etc. Office is a clear outlier there. But for all the other asset classes, including multifamily, the asset values will be recovered almost all the way, if not well beyond, by 2026. So that's not going to be, they're going to be fine in terms of values. They're going to be fine in terms of interest rates. So why wouldn't they be a little more strict here? Because they're not going to be underwater.
They can start tightening the screws a little bit, because they will be able to either sell those assets for minimal loss, no loss, or be able to roll the debt. And it will all be in a concentrated time period where banks and lenders will all have to deal with it all at once. Because that's the other thing is, it's, again, we can say some real estate developers or investors made some bad investments, but it's the banks managing risk, and the regional banks that, not just made loans, but they, bought bonds, whether it's, mortgage-backed securities or treasuries at very low rates, because they, needed to park cash, think that they were very, low risk, zero risk investments. But the fact is, if you had a longer maturity bond that you're buying, the value of that, is absolutely plummeted. And so if they realize the value of their investments, their bonds, they were really underwater. And then they made all these other loans that were also underwater for a variety of reasons. So they can't start realizing all of those losses at the same time. So it's really it's kind of like an exercise of musical chairs to, sort of get to a point in time where they can survive. And it's kind of like it's everybody's problem.
Yeah, that's what that made me think. Like, well, this is useful for me. I think for investors to learn kind of a little bit of the mechanics and the cause and effect of some of these of some of the way that banks are handling assets or whatever, or approving a loan or whatever. But I think that I don't think that this is going to motivate banks any other way. I think that that banks are going to get more strict even without reading this paper, just because of the way that conditions are different, and it's more favorable for them to to finally realize these gains, maybe as it could.
No, I think coming back to the sentiment we talked about, I think we are moving to a risk-on period. So I think people are ramping up, and again, it's leading to the confidence is like, all right, the whole survive until 25.
Almost there.
We're almost there.
Yeah.
November's around the corner. So now they're saying get through 26, pick up sticks.
Oh,
but who knows? We're gonna get there.
The weakness of that rhyme is not giving me confidence that that's
exactly pretty weak. Okay, let's make a quick switch to everybody's favorite topic.
Yeah,
immigration. We're not just talking about Springfield, Ohio, or whatever controversy we want. Mainstream media is talking about. We're talking about immigration, how it's affecting housing, and there's some divergent opinions. And I think Matt and I think maybe have a similar but slightly different take, because we all know. Just here's some facts. Here's some facts we know, Matt. One, we didn't build enough housing after the Great Financial Crisis, right? That started the crisis in itself of just we're undersupplied. And then the pandemic happened, and there's a huge surge of our demand of people buying homes and just housing demand in general. And that increased the price of homes. That increased the price of rents. We didn't build for a minute, but then all of a sudden we're starting to build a lot more. We're kind of at 50-year peaks in new deliveries. We shut down the borders during the pandemic for a while, and then the borders were more or less opened back up.
Ripped open, if you would listen to the right people.
Blown a hole through. And uncontroversially, a lot of people have been immigrating to this country for, I think, almost all good reasons, with some probably bad reasons and bad actors. That's not the point. But there's more people here. There's people crossing the border, and we already had a deficiency in housing. We tried to make it of supply. We still haven't done enough. It's hard to track these people, of how many people actually are here, who's being double counted. But what we're talking about is, what is the effect on housing? Housing costs, and how does it change our calculus of how many new housing units we need where in the United States of America? Harvard Joint Center for Housing Studies, they put out a report. We cover their pieces a lot. They lean left a little bit, but try to be pretty unbiased.
This was great, actually. Just the counterpoint. So a couple weeks ago, John Burns Research and Consulting made a point, and they called to mind some numbers about immigration, and we have them up here. Basically, immigration in the U.S. surged from 2022 to 2023. We'll put aside this graph and just say give their estimate of about 700,000 additional households came into the country over the period of those years. That's 700,000 more than average. Okay. So they say 600,000 of those are probably going to be renters. So let's say we're adding 200,000. So, mental math, 200,000 a year. And we're at a point now where, we're building at record pace, but we're building maybe 500 and 600 on a really great year for construction numbers. So adding,
but we're still in a couple million unit deficit.
Yeah, and we are in okay. So, but compared to the new apartments being brought online, that would be a huge chunk of them. You would think that would lead to rents skyrocketing, and I do think the numbers themselves have a credence, and we'll get into the counterpoint themselves, but it is it's worth noting, it's worth following, and I said then it's probably has a material effect on some of the destinations for immigrants, like border towns or whatever. But it's nothing to ignore, right? It's not it's a measurable, and we'll see if it's a major or meaningful effect. But it's definitely, I would say it would have a measurable effect.
I think that's what it's important to try to get down into, because I think that there's not a lot of argument there is some effect. I think it's how large the effect is. More people, that is with a limited amount of supply, there's that much more demand is going to push prices up.
So that's the implicit argument there. And
but tell us where.
So yeah, the implicit argument there, and they don't really make it. They just they just show you that they're like, hey, there were a lot of immigrants, a lot of rent growth. Now, Harvard comes in with their counterpoint and says, well, let's look at when these things actually happened. And they have a line graph here that shows exactly the timing of this. And when using RealPage and not lagging CPI data, so they're using kind of up to the moment data, Harvard Joint Center for Housing Studies, they find that the time of big rent growth happened before the surge in immigration. That's a full stop there. Peak rent growth, 2021. Peak immigration, 2023. There's some overlap, especially 2022, where immigration is going up as at the same time that home prices and apartment rents are elevated, but they're moving in two different directions. If you really want to make an insidious point, you could say, oh, well, immigrants were going up. Did they drive the decrease of housing prices? Now, you could argue that because they kind of indirectly say this in the article that by saying that immigrants help expand the supply of much needed homes because they account for 34% of people that work in construction trades in 2023.
That's what I say.
But that's a stretch.
Well, no, it is. I think it is and it isn't.
Yeah.
I mean, to be honest, there are so many factors that we're talking about here because I think you're right. At that point in time, did level of immigration affect home prices? It may have, but I think just the bigger factor was supply coming online.
Supply dwarfs any of those.
So that's I think it's a marginal factor, but I think it's going to most likely play out over multiple years because we have added to the population, especially of certain markets in the Sun Belt, but all over the U.S. And as we're going to see supply really taper off at the end of 2025 into 2026, I think that's where we will see potentially higher rent growth than we would have seen if we had slightly less immigration. Now, you made a really good point, though, that one of the I don't even think it's a conspiracy theory. One of the reasons why we're like, hey, let's open the border back up is because we needed the labor.
That
for
was
a variety of things, and especially who do you think is framing the houses? And if we're not having cheaper labor frame the houses are going to be more expensive, and so that's like a deflationary effect. But they still have to live somewhere. So also to keep driving, there's immigration. There's so many variables. There's so many. It's like the intersection of so many different things. I think we can say that more people here will put more pressure on demand, but at the same time, we need to build more housing regardless. And it's marginal, the amount of pressure compared to just what the overall demand is going to be.
It's
and
easy,
we need the labor. It's just, we just need to make sure we have the right people coming here that, are criminals and are here to work for all the reasons why we want immigrants to be here rather than
straight up, whether it's immigration or whatever, it's easier to increase the supply than reduce the demand. And we've seen that in the multifamily market. Apartment demand was huge. We built a lot of apartments, then the rent prices came plummeting down. So there is a solution here. As powerful as demand is, building solves it. Building, increasing the supply solves it.
I think you just hit the nail on the head. If the reason to cut off immigration is to lower the cost of housing, you're really not going to get anywhere with that. You're being around the edges. But the only solution, and this is, I was meeting with the mayor of Carmel, Indiana today, and with their head of economic development, I was telling them the same thing. The only solution worth discussing is more supply. Now, we can also get into the types of new supply. Any type of new supply is moving in the right direction. If you get the right product type, you're moving in even further in the right direction. But just we need new supply. That's the only. Anything else, you're just talking about symptoms and you're beating around the bush.
And to your point there, it's easy for us to talk about as, we're not the ones that yet maybe that are in charge of arguing with the neighbors or with the government officials to rezone a single family into multifamily or whatever. But that's what's going to take. So it's easier to do supply than it is to control demand, but it's not it's not like a snap of your fingers. It's going to involve, on the large scale, if we're going to increase it the way that we want to, it's going to involve some wrangling with community leaders, with community members, and it's going to take some. There's going to be a large group of people that are going to have to accept there's more people living around here, and there's going to be levels of comfort with that. It just means that things are going to be changing, and that's what we'll have to swallow. And the people that want things to stay the same are not helping.
No, I think if we're at the build baby build, that's the only way forward. Yeah. And the reality is, us saying that, that's the obvious solution. The less construction that goes on is better for like our business technically, because if there is less supply, that means rent is skyrocketing. That means there's more demand on the investment side. There's fewer properties to buy. I mean, if we never built anything ever again, our properties would absolutely skyrocket in value the day that announcement was made. So it's not in our best interest for there to be a ton of new supply, but I'm going to be an advocate for, more supply every single day, because that is the solution. That's what we talk about every single week on this podcast. It's pretty damn apparent.
And in those arguments, right, when we're arguing for more supply, hey, I want to build the apartment. No, you don't. Like, sometimes the locals are right. Like, it's not like I'm talking about building an apartment in every block wherever you want to, but I am saying, like, you got to have these hard discussions. It's going to be hard, but it's going to be worth it.
And one of the points...
Much easier than the alternative.
Yeah, much easier, better than the alternative. Point that I was making, Carmel, Indiana, it's a suburb just north of Indianapolis, highly affluent. The point I was making is that in the residents there don't want new apartments.
Yeah, no one does.
The fabric that Carmel or many other affluent suburbs are made up of and have been made up and built upon over the last 30 or 40 years, those individuals that have moved into those communities, and they bought a home. If those same individuals were trying to do that today, many of them would not be able to afford to move to those communities. And so we have to detach the idea of single-family home ownership as being the only ticket into a community or as a ticket to building wealth, and looking at building wealth in a nest egg, decoupled from where you live. And maybe it is you are buying, but maybe you're renting and you're investing elsewhere. But the reality is, again, even with the median income of $120,000, in that range, the average home, somewhat affordable, kind of in the $400,000 to $600,000 range. That's affordable these days. You're still going to need $80,000 to $120,000 for a down payment if you're doing a traditional mortgage. And some people have that, but the majority don't. And so you're just having people priced out, and you have to have some sort of solution for everybody. And so now if they build, for like we were discussing about like the missing middle, and again, we're going to get this back to immigration because, again, it's all supply. It's what we need for everybody. If you build the right type of housing, it's in that range, that's great. But oftentimes the only thing that pencils is about building really high-end housing. And so it's counterintuitive, but you build that high-end housing, you're like, that doesn't go and serve all the people that need housing right now. You're just serving, the top 1% and the wealthiest. But what that does is it allows those wealthy individuals to move out of their home into the new construction, and it allows the cycle to continue. So that family that's then stepping up into that next home, that home is at least available. But right now supply is restricted because you've got all these baby boomers, for example, who are living in 2, 3, 4, 5-bedroom homes, and it's just them and their husband or wife and all these extra bedrooms. So a ton of underutilized housing. And it's because, like you said, they don't want change.
Well,
they're like keeping it for Thanksgiving. They're like, we it's just us, but we want to have the dining room for Thanksgiving. And that's it. So you have to have the solutions for those folks to say, hey, look, we've got this highly amenitized, high-end condos, townhomes, whatever it is for you can move into, and that frees up the rest of the supply. So again, high-end, it's not going to fix the middle directly, but indirectly it does because it frees up supply down the chain.
I've seen it throughout the city. I've seen, where there once was maybe an office building, even apartments, where there was single family apartments. I think that you see it probably throughout the country in some of these like border suburbs that are turning into little mini urban centers. And maybe it was a grand master plan. I think that Carmel, specifically Carmel, Indiana, there was, I think, some oversight. And they specifically wanted to build this kind of urban feel.
Yeah,
but some of them, you don't need direction to do that. It just happens naturally. You want to build these apartments, you want to make it more dense, then that's great. Then there are more people there to be the manager of the shop that you shop at, to be the landscaper, to be the plumber, to pay for all of this infrastructure. Whereas, and this is harkening back to a long ago Gray Report video where it was talking about how these new how new suburbs are great because you got all the new infrastructure and you got the all the pipes, whatever, it's all new, and so you don't kind of have to pay the upkeep that an old city would have. Well, when it's aging now, Carmel's been around for a little while, and I think it's making this transition from something that is a new destination to it's kind of growing into a city in its own right.
I think it's coming into its own.
Yeah,
it's kind of growing up a little bit. They're finally making that transition, but they're trying to be thoughtful for the next chapter. There's a new mayor, obviously,
and there's a lot of arguments, I'm sure, that happen.
A lot of opinions.
Yeah.
A lot of opinions. Okay, let's move on. Just because I know we're limited on time today, Matt. A report from the Institutional Property Advisor: near record product absorption maintained through third quarter. So basically, they're talking about some good news. Let's talk about absorption. Let's talk about the fundamentals of multifamily.
I paired this with the apartment list, and just going to kind of fly through both of them really quick. Yeah. The Institutional Property Advisors, they talk about an upside surprise, and that's good. Yeah, so it's like the expectation based on RealPage and Institutional Property Advisors data is 442,000. Sorry, I don't have the chart up here, but I can just give it to you verbally. 442,000 of absorption total for Q3 2023 through 2024. Using CoStar data, I actually wanted to get what CoStar would say, and they have it as 574 absorption by year end for 2024, but that compares to 670 deliveries estimated by the end of 2024. Newly built supply, still the biggest factor in the market. The total for 2020 to 2024 is 2.15 million for absorption, 2.6 million for new supply. So I'm rounding a little here, but it's clear that supply has outstripped demand for the first half of the 2020s. Yeah. And that's including the times when there was this huge demand, and that's also including the times when demand dipped down because of the new supply. And also, I would argue, because of the growth in rents, maybe it was a little stronger, but that's an argument for Jay. That being said, this is a report on apartment demand, and that surprise to the upside could mean that apartment supply and demand are coming into balance more quickly than expected. I may be wrong. Maybe demand is easier to move than supply, but I'd like to think that there is going to be some tailwind, some momentum to the demand in a way that we won't maybe see with supply. So that's the IPA. The Institutional Property Advisors. I do think that the word upside surprise always has like it's an upside to you. It's like the landlord's upside is a renter's downside. So I just want to include that caveat at the end.
That's true.
Yeah. Okay, so moving into apartment list, this is, I think, a very instructive contrast with the above reports focus on strong demand. They actually, when it comes to demand, it's vacancy, it's a little bit related, but they say that that the vacancy numbers have ticked up from 6.7, it was at 6.7 for 6 months, and then to 6.8. Not a huge movement, but something worth watching. The real thing that I really wanted to come at is their month-over-month rent growth numbers. Now you can see the vacancy here. It looks like it's
unchanged.
It's almost like flat.
It's a wash from 2020.
Yeah, and in that,
which again, and I just wrote this on another quarterly report. In the face of 50-year record supply, vacancy essentially unchanged from July of 2020 is incredible.
And I do want to note that even this,
when supply slows down, I don't think vacancy increases. I mean, we have some more absorption to go through.
That's exactly right. So we're coming down from this this wave of new apartment supply, and there are other numbers like from RealPage that have recorded it's like more positive numbers for occupancy. So then I will be the first to keep following the numbers if there's an uptick on vacancy, especially from apartment lists, because I like to know, if they're disagreeing or agreeing. But there's reasons to be optimistic that that the vacancy numbers are coming down. On the other hand, if you're looking for optimism on the rent growth side for the apartment market, you may be a little bit more disappointed because it is negative 0.7 rent growth year over year for the apartment market. and negative 0.7 rent growth month over month for the apartment market. I'm looking at this is the key chart here. If you look at the month over month rent growth, and you compare it to 2023 to 2024, then almost exactly the same. You're really getting a mirror image. It is almost really it may be almost exact. It may be. Yeah, very similar. That's all I'm trying to say. It's striking. But I think that we are in a completely different place right now. I think the numbers may shake out to be a little more positive this year than last year, but it's a sobering reminder of the state where we are. And
I don't know. I mean, I could see pretty rough numbers this winter, Matt. Things slowed down a little bit sooner seasonally than they typically do. And again, we're facing a lot of this supply. And it wouldn't shock me if we see one final maybe slide downward in rents, just as we usually do seasonally, but it may just be a little bit more pronounced. Or maybe it's normal, just we never had the growth in the spring and summer months to really kind of make up for it. Where like 2019, you look at this chart where you have, multiple months that are kind of getting close to 1% growth just in a single month. And then you have the latter half of the year, which is, relatively negative. People are already in school. Just the leasing season is generally done. We just didn't have that surge, or maybe half of the surge in this typical leasing season, but the declines are even further because landlords are looking to optimize for occupancy, getting heads in beds and saying, oh man, I'm already at only at 85% occupancy. I'd rather get the extra 5% lease to 90% to have some income coming in rather than none. And I think there's also a recency bias in the industry in terms of rent growth, is that we've now had 2 years of very kind of sluggish or no real rent growth, of basically property, managers have successfully argued that, like, hey, look, we really shouldn't raise rents. Like renewals.
The algorithms were supposed to fix that.
Yeah. I thought that
the algorithms did not make rent grow a lot these past 2 years.
They're broken. Well, same thing. It's boogeymen, immigrants.
That's a good Halloween. That's good.
Yeah. So that would be good. Yeah, you could do a real page algorithm for Halloween.
Man, that's a good one. Costume. Yeah.
Yeah. But what are the boogeymen that are being thrown out there that are just it's marginal issues, immigration or real page.
Yeah.
Do they both have an effect? Sure, but I think you bring up this great argument. Well, then why have we had negative rent growth? Why have we seen some price declines if that's the thing that's moving the needle? And just because
they knew they were they knew they were going to get investigated, so they're like, let's dial it down. And
maybe that's how that works.
I think,
we're in a recent bias of we're not going to have any rent growth, and I'm like, look, this supply is going to be slowing down, whether I think it's second half 25, early 2026. And again, go back to a chart that has the last couple of decades. You see declines like this in a year in terms of rents. You see growth after those. But I think there's more pent-up demand, and I think we're going to see that supply surge cut off just because rates have been high. It's hard to develop. You can't find the equity or the debt to develop.
I did check after our discussion last week. I checked on the multifamily construction numbers, like how many units are under construction at a given time. The peak was like around 1 million. The maybe like elevated high point was like 600,000, and we're at our like 820,000 are under construction now. We are coming down from
we're still delivering a lot.
Yeah.
But we're sliding down.
Yeah.
So this is a time for patience. Again, I think like we're talking about things happening in the course of like 2 years, not months. We're talking a year, 18 months. And it could be in 9 months, but it's most likely going to be a year to 18 months before we really start seeing that turnaround. And if it happens, maybe the pandemic or the algorithm changes this. But in the pandemic, we saw it in 2020 and really kind of the first half of 2021 when there was all this demand, but there was recency bias to the pandemic, and the bias was no one's going to have a job, no one can pay rent. Let's lower rents, let's give credits and concessions, and the market's going to crash.
Yeah.
But then it took, some landlords a year to realize, oh, everything's 100% occupied, and the neighboring property has increased rents by like 10%, and I'm all of a sudden under market significantly. Oh, but I just renewed my entire community, or I just renewed all of these leases. And so when you miss out on a year's worth of growth and being below market, good for the renter. But I'm just saying, if you're trying to optimize and stay on top of the market of just being at market, which that's what the algorithm's supposed to do. You don't need necessarily an algorithm to do it. You just listen to the Gray Report or just pay attention a little bit. So there will be that delay when there will be demand, and it's important to stay on top of it. That's why you got to subscribe to the Gray Report. Hop on over to the Gray Capital YouTube channel. On YouTube, you can go to grayreport.com and make sure you sign up, not just because you're subscribed to the news or to the podcast YouTube show, but the newsletter is where all the meat and potatoes are.
Oh, yeah.
That's where all the data is. That's where the reports are, and that's where we're going to keep you updated on a bi-weekly basis. Thursdays at 8:30 in the morning. That's when the big kahuna gets dropped by Matt Bosnagel. And it's consistently rated as the top commercial real estate newsletter, at least this side of the Mississippi. I don't know about the other.
If you had subscribed to the Gray Report, you would already have read the Fed extended pretend paper. Some stuff comes in, we don't talk about it. You'll get everything on the newsletter.
Yeah, it's a lot of times on here. Yeah, we're catching people up. If you have been a reader of the Gray Report, been listening to the podcast, took some of we're not giving financial advice or anything like that, but if you kind of followed our lead, I think you would have made some really good investment decisions the last couple of years. And if you're an accredited investor, and if you would have invested in some of Gray Capital's deals, you'd be in a really good spot.
Yep.
Never lost a dollar, investor dollar. And I'm very proud of the investments that we've made over the last couple of years.
This is not official investment financial planning advice or whatever. What's the disclaimer? We are not
screw the SEC.
But they are good ideas. That's what I'm gonna say.
It's education.
Yeah. But it's good education.
Real estate. We can do real estate advice, consulting. No financial advice or consulting.
Yeah.
We don't have to talk about what we can't do.
Good advice.
What we can do is put some really great deals together, make everybody a lot of money, especially if you're an accredited investor. Nothing's guaranteed in life. And obviously, make sure you do your own research, consult your advisors. Don't be smart. Be smart out there. That's why we do this show. So be really smart. Just put it all out.
Hey, if we're wrong, hit us up in the comments. Love to learn.
Yeah, and we probably are wrong on a couple things. Yeah, we want to know. Thanks again. Give this video a like. And again, leave a comment.
Yeah.
We'll give you a shout out if it's good. All right. Catch you on the next episode.